Hello, everyone. My name is John Nicholson, and welcome to the Alltech CHAR, Making Dollars and Cents of the Carbon Tax and Credits. CHAR and Alltech are basically the same company. CHAR is a publicly listed company on the Toronto Venture Exchange. YES is the stock ticker symbol, and Alltech is a subsidiary of CHAR. Thank you all for joining. This is a 1-hour session. It's going to be going right till 1 o'clock. We'll have a hard stop at 1 o'clock because I know everyone is busy, including myself. But if those of you would like to stay on, have more questions, we can certainly entertain them after 1 o'clock, but I'm going to have a hard stop at 1 o'clock. Also, this is being recorded, this session, and we will also be posting it on the CHAR YouTube channel and then sharing the slides themselves with those who are in attendance. So there's no need to worry about that. With respect to the program itself, the formal program, we're going to have 2 speakers, which I will introduce in a moment. The formal part of the program will go for 45 minutes approximately, give or take, and we'll have 15 minutes for questions and answers. If you have a question, the chat is disabled for this webinar, but there is in the lower right-hand corner a location where you can ask your questions, and they show up with the panelists, and of which I'm one, and then the other 2 speakers are panelists, and then we'll answer them at the end of the session. So as you think of questions, just type them in on that question button in the lower right-hand corner of your Zoom. What else is there to me when you say? Okay, so the speakers are from CHAR. We have Mark Coral. Mark is CHAR's CFO. He has over 20 years experience as a CFO in a broad range of industries. He has lots of letters behind his name, the key ones being certified public accountant and chartered financial analyst. And he's going to be speaking first, followed by our second speaker, Elham Garuhi. Elham is a senior project engineer and practice leader at Alltech's permitting and compliance group, and she has over 15 years experience in the environmental sector. So we have 2 very seasoned, knowledgeable people who are going to be speaking. So I'm going to hand over the microphone to Mark. So Mark, are you there?
I'm here. Thanks, John.
Okay, take it away.
Thanks for the kind intro, and thanks everyone for joining us today to cover a very important topic which will impact us for the next 3 decades at least. We are at a major inflection point, undergoing a paradigm shift in a new era of climate policy. This will be a pivotal point in our future. And just before we kick things off, we wanted to start with a poll. If you could kindly participate, we'd appreciate it. Okay, thank you. So in terms of awareness, I think that's one of the reasons why we're here today. Carbon finance is the next frontier. It's, in layman's terms, that means it's the next big thing. The emerging market of the carbon allowance commodity has returned 18.74% per year from 2014 to 2020. It's outperformed global equities at 13.18%. Real estate yielded only 5.86%, and bonds, it's outperformed the 3.88%. Commodities was easy because the commodity prices actually fell over that period of time, although there's been a a small recovery in 2021. Barclays Capital, a prominent investment bank out of London, is quoted as saying carbon will be the world's biggest commodity market, and it could be the world's biggest market overall. So that certainly has caught our attention, and that shows what kind of market potential there is in this, and I'm going to term it a commodity in this presentation. This on the left, this is an ETF, a carbon ETF, which is pegged to 3 of the top carbon exchanges or markets in the world. So it's meant to replicate the performance and the pricing of carbon allowances. So this year alone, it has a 40% return, and over the last 12 months, it's topped 100% in terms of the annual investment return. So in layman's terms, again, the carbon allowance commodity is really the cost of polluting air. As a follow-on to cryptocurrencies and fintech, the next big thing will be carbon finance. The carbon credit market is evolving and will become increasingly important over the next decade and could grow to $1 trillion US. And that's on the low end of our research. If we're to put Barclays' comment into perspective about the world's biggest commodity market, well, right now we've got the cryptocurrency market is at 2 trillion, and we've got the gold market at 8 trillion. So there's tremendous room to run, and yeah, we really think that there's tremendous potential there. Excuse me. The top 3 carbon markets have current annual trading volume of 257 billion. And most recently, the Supreme Court of Canada has ruled that a federal carbon tax system is constitutional. So that has put Canada on the global carbon map, so to speak. So in essence, companies who reduce emissions will be financially rewarded, while those who do not will be penalized. So you can either ride the wave or get hit by it. And we are in the early innings here. This busy graph here, and I'll break it down in simple terms here. The first part of the graph from 1990 to 2020 shows Canada's performance in terms of reducing emissions, which have actually gone up. The purple segment between 2020 and 2030, the decline there is the emissions reduction under the Paris Climate Agreement. And then from 2030 to 2050, that's the additional decline that is needed to achieve the zero emissions that everyone's talking about by 2050. So we've made little progress to date. The best is yet to come. This certainly bodes well for the carbon market. And the last point on this slide is, in order to hit the 2030 target for Canada, we would need to have a carbon price between $50 and $100 in order to achieve that. So there's also a big trend in sustainable investment assets. There are 51.4 trillion in assets managed at the end of 2019, of which 17.1 trillion were attributable to sustainable investing assets. That represents about a third of all total assets. Now, this was under the Trump administration, and it's only going to grow under the Biden administration, which has garnered a lot of momentum and attention going forward. In fact, in a January 27th executive order, Biden elevated climate change to an essential element of U.S. Foreign policy and national security. He also, the U.S. also rejoined the Paris Agreement on climate change, which is very important to call it the carbon future. So this trend or movement, I'd like to call it, is both global. It's a global one in nature. We've got Europe, the U.S., Canada, Australia, New Zealand, Japan participating, and the growth in this asset class is close to or at exponential in a lot of these markets. And bottom left, that is the growth in the U.S. market over time, and we know that that's up to 2018, and we know that the growth from there has been at an exponential rate. Now, my last point on the slide is China, the world's largest GHG emitter, is adopting a carbon trading system in June of this year. It was supposed to launch in February, but it seems as though China is all in with respect to these global strategies, which is a very important piece from a competitive standpoint as well. So to demystify carbon credits, a carbon credit is a tradable or transferable certificate giving the right to emit 1 ton of carbon dioxide or the equivalent GHG gas. It can be traded at the market price in the international, on any international exchange. We're in the early innings here. There are 5 key exchange platforms right now, and that's set to keep growing. And they're similar to stock exchanges, except you can buy and sell credits and buy and sell futures related to those credits. Another catalyst for the market is the federal government has proposed $65 a ton in 2023, rising to $170 per ton in 2030. And if we look at the price today at about $24 Canadian to $170 over the next 10 years, then we get a CAGR, a compound annual growth rate of 24% each year over the next 10 years, which would be a pretty phenomenal return. So the key to carbon economics is shrinking the footprint, the carbon footprint. Those that reduce their footprints will be the winners and be rewarded with credits and revenues, and those who do not will face challenges, buy carbon credits, and have to face penalties, and those are extra expenses that their operations will be burdened with. The pricing trends will be strong over the next decade and likely all the way up to 2050. The market and all of the pricing fundamentals look excellent going forward. There's global support with 197 countries now. Basically every country on Earth is supporting this movement, and carbon allowances are a valuable commodity that by all indications will continue to increase at a substantive rate. And we feel that it's the next big thing. Now I'd like to pass the torch to Ellen. She's a professional engineer, as John mentioned. She knows plant processes and how the carbon credits and taxes work at the operational level. She will get into the practicalities and more depth, as well as a real live case study. Thank you, Ellen.
Thank you, Mark, and thank you, John. Yeah, Mark explained a little bit briefly about the global trend, and he provided good insight on those areas. I'm going to take a step back and focus more on the Canada-wide carbon solutions and Canada carbon tax problems. So the subjects that will be covered in this part of the webinar will be an overview of Canada's statistics on GHG meters and sector province distributions. Then I will explain a little bit about the federal carbon tax and its implications to the industries, and Canada's plan toward net zero GHG emissions and made in Ontario emission performance standard and total annual emission limit under this program. And finally, we will explain a case study of Ontario manufacturing facility that perform economic analysis of impact of EPS program and opt-in opportunities. I see that the poll is on your screens right now, so please answer the questions based off your knowledge. Choose an answer that best describes your facility. We would like to know more about the sector that you're located in. All right, so per GHG reporting regulation, facilities that emitting 10 kilotons or more of GHGs are required to report their emissions. For the reporting year 2019, 1,700 facilities reported a total of 293 megatons of CO2 equivalent emissions. This represents 40% of Canada's total GHG emissions and 64% of total industrial emissions. This map shows the distribution of GHG emitters across the country. As you can see, while most of the GHG emitters emitting about 1 million tons are located in Ontario, those emitting over 2 million tons are mostly in Alberta. Additionally, most of the reporters in terms of number of facilities are located in Alberta. Among all reporting facilities, most of them are in the range of 10K to 50K tons of CO2 equivalent. 1,030 facilities reported GHG emissions at this range, accounting for 8% of the total reported emissions. These facilities belong to a number of sectors such as oil and gas extraction, manufacturing facilities, including food manufacturing, and waste treatment and disposal facilities. On the other side, 61 facilities that are emitting in the range of 1 million ton and over are accountable for more than 55% of the reported GHG emissions. These facilities include sectors such as electric power generation, oil sand extraction, petroleum refineries, and primary metal manufacturing. On the left-hand side graph, you can see that 30% of the GHG reported are related to the manufacturing sector. Further, this figure shows the distribution of facilities emitting between 10K and 50K by province. Alberta had the highest number of reporters, followed by Ontario, which had 250 industries reporting in this range. Carbon price in Canada is legislated under the 2018 GHG Pollution Pricing Act, which includes two sections, output-based pricing system or OBBS, and carbon levy or federal fuel charge, also known as federal backstop. The OBBS is designed for large industrial emitters that are emitting over 50 kilotons of CO2 equivalent. It is right now in place in Ontario. Opt-in is available for eligible industrial activities emitting between 10K and 50K tons. And it has defined output-based standards, which is defined as CO2 equivalent in tons per unit of measurement for eligible operations. Federal fuel charge, or FFC, is based on a carbon tax of $30 per year to 2020, increasing $10 per year, and it has numbers up to year 2022. Ontario's small or medium-sized industries and personal fuel users like us are all paying FFC through our fuel use, like our natural gas fuel use or diesel or gasoline. As an example for OBBS, consider a production process that has an OBBS standard of 0.3 tons of CO2 equivalent per production unit. For any emissions above the standard, compliance obligations must be met by OBBS participant. In the left-hand side figure, facility C has emission of 0.4 tons of CO2e per production unit and needs to pay for credits. For any emission below the standard, the facility received credits, facility B. So the green shade means revenue for facility B, and red shade means expenses for facility C. As a real example, the production of steel in a basic oxygen furnace has an OBBS standard of 0.164 tons of CO2e per ton of steel. On the other hand, federal fuel charge has a set price that applies to all energy used at the facility, and this price is $30 in year 2020. The Government of Canada has released a new federal climate plan in December 2020 entitled A Healthy Environment and a Healthy Economy. This plan is built on the 2016 Pan-Canadian framework, and it claims that it will do more to cut pollutions in practical and affordable way compared to any other climate plan in Canada's history. It also claims that this plan will help Canada to exceed its 2030 emissions reduction target under the Paris Agreement and achieve net zero emissions by 2050. Under this plan, the government will pose different measures to reach that target. The first is to increase carbon prices annually. The federal backstop carbon price will continue beyond 2022, the year in which this price is set to reach $50 per ton. Thereafter, under the plan, the federal backstop price will increase by $15 per ton annually, starting in 2023, and reach $170 per ton by 2030. Second approach is funding for small or medium-sized businesses. These businesses can seek funding of up to 25% of eligible costs for projects to improve energy efficiency and productivity. Another measure is to mitigate the risk of carbon leakage. To do this and maintain the competitiveness of Canadian companies, the federal government plans to explore potential border carbon adjustments and work with economies like EU or Canadian North American partners to consider how this approach could fit into the border strategy to meet climate targets while ensuring a fair environment for businesses. The plan also has significant support for innovative, low carbon or net zero related technologies. The new Net Zero Accelerator Fund, delivered through the Strategic Innovation Fund, is to expedite decarbonization projects with large emitters, support clean tech development for aerospace and automobile manufacturing, and support the Canadian battery innovation and industrial ecosystem. And finally, it will develop requirements and guidelines for carbon offsets. Now let's focus on the Ontario plan. The Emission Performance Standard Program, or EPS, built under the Ontario Regulation 249/19, is one of the Made in Ontario environmental plan commitments in making polluters accountable for their greenhouse gas emissions. On September 2020, the federal government has accepted this Made in Ontario EPS program as an alternative to the federal output-based pricing system. On March 2021, just recently, the federal government has announced that will move Ontario to EPS system as of January 1st, 2022. The program regulates greenhouse gas emissions from large industrial facilities, and it sets standards for lowering emissions that facilities are required to meet. If an industry does not meet this standard, it will have to pay. Industrial facilities in Ontario can gain by reducing their emissions through innovation. The more industries reduce their emissions, the less they have to pay for their pollution. In fact, industries can get credits for any reductions that surpasses the standard and can sell or trade them to other emitters in the program. The EPS program has very similarities to the OBPS, like it is mandatory for emitters over 50 kilotons of CO2 equivalent. Opt-in is available for industries emitting between 10K and 50K tons of CO2 equivalent. And specific industrial activities are eligible, same as OBBS. However, the list of activities are a bit different than OBBS. But what are the some of the major distinctions of the EPS from the OBBS? Unlike the OBBS, the EPS program phases in stringency over time and gives Ontario industries some time to meet their obligations. Also, activity limits or standards are calculated based on different industry-specific factors. As opposed to a blanket cap, EPS regulation includes a tailored approach appropriate to the specific regulated industry. As mentioned on the previous slide, the EPS program phases in increased stringency or strictness over time, or decreased stringency factor. The concept behind the stringency factor is that facilities reduce their GHG emissions gradually over the years. An emitter's annual emission limit will be a function of its industry performance standard. An industry performance standard will be calculated by multiplying the average emission rate for that industry by a stringency factor as determined by Ontario. Ministry has published declining stringency factors for maximum annual emission limits for different processes up to compliance year 2022. For instance, you can see the stringency factors for general combustion listed in this table. Facilities that participate in the EPS program, whether mandatory participants or volunteer participants, have to calculate the total annual emission limit for the facility for each compliance year. TAEL is some of the different annual activity emission limits for different processes at the facility. For instance, AECL, or annual activity emission limit, is calculated differently for emissions from general combustion than for emissions from cogeneration units. The stringency factor and methodologies are also distinct for different processes. Now I would like to present a case study of an economic analysis we performed for a large blue chip Canadian company with multiple facilities across Canada and US. We performed financial and economic analysis for one of their facilities in Ontario using our proprietary EPS modeling tool. This facility has different GHG producing processes and a cogen unit. Facilities activities were eligible under EPS requirements, and the emissions were in the range of 10K and 50K tons of CO2 equivalent, which gives them an opportunity to decide to opt into the EPS program or stay out and pay taxes through federal fuel charge. The approach we took to perform the economic analysis was first to determine the GHG emissions based on their process areas, because as I explained before, the annual activity emission limits calculation are different based on different operations. Next, we calculated their annual emission limits and TAEL for their facility. And using our modeled carbon tax projections for the 10-year period, we determined the economic costs of opting in or staying out of the EPS regime for the facility. This analysis included a projection of carbon limit cost, compliance emission limit reductions, limit attritions, and projected business expansions affecting GHG emissions. And finally, we identified revenue generating opportunities available to the facility under the APS regime. As I explained, to give them a better understanding of the future implications, a 10-year analysis was performed using our modeled GHG under EPS regulation. We assumed two scenarios for them. The first scenario, business as usual. We calculated the amount of TAEL and FFC paid under this scenario. And the second scenario was business growing over the years, and the GHG emissions for general combustion processes are increasing by different percentages year over year. I only represent the results for the business as usual scenario here. The other scenario had more variables included in it and is more complicated. For the BAU, we assume that the GHG emissions are not increasing or decreasing over the years. By calculating the annual activity emission limit for all operations at the facility, we determined total annual emission limit for the whole facility and be able to financially analyze their situation for the period. The results showed that the facility's actual GHG emissions are lower compared to the performance standard for that sector, leading to TAEL numbers higher than actual emissions. It's mostly because their cogen unit has a very good performance. As such, facility has some units available to sell or save for their potential future use or transfer between their other participating facilities. The revenue projected for them for each compliance year is presented in this table. For instance, for year 2028, it's projected that they will have around $700,000 revenue from selling credits to other participants in the EPS program. This table shows the amount of carbon tax that this facility have to pay if they do not opt into the EPS program and pay taxes through federal fuel charge. This means that by opting into this program, they can mitigate carbon tax by $4 million for the first 4 years, and this number would be $17.7 million for years 5 to 10. And this figure also shows the relation between the facility's actual GHG emissions and annual emission limit for this facility. Although the annual emission limit declines due to increased stringency and the gap decreases year over year, the facility would still have around 5,000 tons of CO2 equivalent credits to sell with a revenue of $767,000 in year 10. So we determined some opportunities for the revenue and cost avoidance for this facility for the first three-year period, 2020 to 2022, that we actually have the numbers for the carbon tax. If the facility decides to opt in, the tax saving from federal fuel charge would be $3.5 million for these 3 years. And they will have $700,000 in revenue if they decide to sell the credits and opt into this program, which gives them a total economic benefit of $4.2 million by opting into the EPS program. I also want to mention that there are some fees associated to the report verification, registration fees, and account management. And the summary of financial analysis for the 10 years, the facility would use 5.8 million gigajoules of energy in 10 years, would have 300 kilotons of CO2 equivalent GHG emissions, and the total economic benefit of opting into the EPS program for this facility would be $26 million for 10 years. I just want to note that these results of this analysis cannot be used to extrapolate for any other operations or facility. It's just specific for this one facility with their own operations. And because, as I mentioned, the performance and standards calculations are very process specific. And finally, I would like to introduce our new carbon finance unit. In order to better serve our Altex and Char Technologies customers, we kicked off this new business unit on March 31st, 2022, This unit basically marries our finance capabilities and environmental engineering capabilities, and we provide a unique offering to our clients. This unit has some trade finance capabilities and investment advisory services. Now I would like to hand it over to Mark for the final key takeaways, and I want to thank you for listening to my presentation.
Thanks, Ellen. So just a few basic key takeaways for today. Carbon, the first one is carbon is a huge growth market with prices growing by approximately 25% per year going forward. It's a financially lucrative arena. There is a carrot and there is a stick. You either have to ride the wave or get hit by it. It's critical for you to understand your carbon footprint and how to maximize value or minimize expense. Investing now brings excellent returns and many ESG benefits, which will grow in the future. And carbon allowances are a relatively new commodity with massive growth potential. This is the next big thing. John, back to you for questions.
Okay, great. Thank you, Mark and Elham. Okay, we have a bunch of really good questions, and if you have some more as they're getting discussed, feel free to type them in. It's a bottom right-hand corner of your Zoom. There's a place for questions and answers. We see them, and then we'll read them. So the first one came in, I'm not going to say who it is, so I won't be calling anyone else, is how much CO2 emissions were reduced during the COVID year of 2020? And I don't know if you know that off the top of your head, but I do, because I saw it and I looked it up. It was 6%.
Thank you, John.
6% reduction 2020. According to an article in Nature magazine, and that is 2.3 billion tons reduction from COVID. Okay, the second question is, how will the service be priced? Someone asked. And when they say service, maybe it's the clean tech service, the combination Alltech CHAR's carbon finance unit. You think that's what they're asking, or something else? Mark or
Ellen, do you want to give that a shot with respect to a specific project? I'm speculating it might be project specific.
So in terms of the price and services, if we want to include technologies in our calculations and determining the prices for them, the carbon footprint calculations will also included in the determining the prices. And so basically, if you're reducing your GHG emissions, that will have some benefits as like carbon offsets that will reduce the final price of your product. So these kind of calculations will be included in this determining the final benefits or revenue for each processes that we're reviewing.
Yeah, I think you could say with confidence, the client that you did the case study for was extremely happy when you presented those numbers to them.
They were very, very happy because they
But I don't think they were too concerned about the bill when they saw the millions.
Good cost benefit analysis.
Yeah, they didn't even think that opting in could have some benefits for them. They thought that why should we bother opting into EPS program while it's not mandatory for us? But but the results show that it has huge financial benefits for them.
Okay, next question. Okay, is Ontario's EPS, which is Emission Performance Standard Regulation for industrial organizations, is it unique, or is it similar to, or what kind of similarity does it have to the other regimes that were in place?
It has some similarities to the output-based pricing system as before, as I mentioned. but it has some differences as well. So the similarities are it's mandatory for participants over 50 kilotons. It has opt-in opportunities, but the differences is that it's not just having a simple standard for that sector. You have to calculate based on your processes, and it also has the stringency factors, which is published now by year 2022. But what we did in our model, we did some projections for the year after 2022, from year 2023 until 2030, that we did some projections based on carbon market and for the stringency factors as well.
Okay, super. Okay, question is, are you dealing with voluntary offset credits? And I think it's with respect to that case study, maybe. Voluntary offset credits.
Yeah, so what we did, we just calculated their potential of if they opt into the program. So they will have credits because they're voluntary participants. They will have voluntary credits. Our business unit that Mark is heading will be dealing with these tradings and credit, credit trading and marketing businesses on that side.
Okay, next question. What is the benefit of opting in for any company that's currently emitting between the 10 and 50,000 ton annually greenhouse gases? What's the benefit to them for deciding to opt in?
Mm-hmm. So, the example that I gave is for one of our clients, which are between 10K, they're emitting between 10K and 50K tons of CO2e, and we did the financial analysis for their facility. The major benefit for them was to avoid taxes, pay taxes through federal fuel charge. So that's all financial benefits for them, their processes were specific that made them to have some credits also to say, but even if they didn't have any credits to sell, like the tax avoidance would be a major mark to be able to opt into this program.
Okay. Next question. When planning capital and operating expenditures over the next 5 to 10 years, someone is asking, should our company use this escalating greenhouse gas trading costs in our calculations for budgeting? So they're just wondering, they're going to figure out some capital operating. They want to know if they should factor this in.
I think doing a sensitivity is always prudent, and it's certainly more conservative from a cost perspective using the escalating numbers over time. But I think the other component to bear in mind here is it could be higher than that or lower than that. So it is important to do a number of calculations at different levels.
Okay.
Pricing levels.
Okay. Next question. What are the average annual compliance costs for voluntarily opting in to the EPS? So what's the compliance costs, i.e. accounting costs, legal costs, etc.?
So because the EPS program is very new, it's not determined yet, these costs, but we assume that we consider that it's not be huge compared to the benefits that some companies can get from opting into the EPS program.
Okay, next question is, what if there is a change of government? Could this tax go away?
That could, if Trump doesn't get reelected, I guess just looking at the global landscape, there is a lot of unification going on here. So I think it would take more than one regime to change to have a significant impact on it. And, China is participating in this as well as most of the Asian countries. And it's been well established in Europe for a number of years now. And Europe seems to have a very good system. But I mean, the wild card would be something like, Trump coming back in 4 years and doing the same thing that was done with the Paris agreement.
And what about Ontario or federally? Mark, would that make any impact on this?
I just want to add, to the Mark's points. Just the Supreme Court of Canada just announced that the carbon price is constitutional. So I don't think that the change in government will have effect on that.
Okay. Next question is, do you consider COVID-19 as an outlier or black swan or a big shock in your scenario, or to analyze or not? What are the logic? What's your logic for such a phenomena, and what if analysis? Hopefully that makes sense. Does that make sense?
Yeah, kind of. So we determine different scenarios. Like for the facility, the first scenario was business as usual, no changes in the operations. But if the COVID-19 hits the manufacturing facility, their production might change because of that affection. So there are different scenarios. Our model has a very good capability that we can predict all these changes in the operations into our model and include it as a different scenarios.
Okay, next question. Will there be any government programs that assist carbon intensive companies? I know, Elham, you mentioned that small and medium enterprises, there's money. This is for carbon intensive, probably bigger ones, to convert to less carbon dependent fuels. And then it goes on saying some businesses are competing versus China and India, and this tax appears to be another hindrance to staying competitive. So who's going to tackle that one?
Well, I guess I can lead off here. In terms of, the U.S. has announced green stimulus funding, a lot of that, and also in the Canadian budget, there are a number of new programs out. So, I think that there's going to be a tremendous amount of government funding, along these lines available.
Okay. Okay, next question is, it seems that some companies could potentially profit from doing retrofits and then selling the greenhouse credits. Do you see this potentially happening?
I can answer this one, Mark, if you don't mind.
Oh.
So yes, if the companies can reduce their GHG emissions, there is a chance that they get credits and be able to sell that into the market. But there are different scenarios as well. They can bank their credits for their own future use, or they can keep it and sell it later when the prices are going higher. So there are different scenarios, and which needs a strategic plan. You cannot just say that I reduced my GHG emissions and I will sell it in the market. So there are lots of factors affecting this.
And they are likely an appreciating asset going forward as well.
Yep.
That sounds like accounting talk.
It is.
Okay, next question. Do you foresee a global greenhouse gas emission trading scheme such that a company could have a wider pool for buyers of its credits. So someone has credits and they want to make as much money as possible on it.
Well, I think, you know, the markets are all evolving here, and I think that's going to be the ultimate goal and that would level the playing field, at least theoretically. But I think that would be what the main goal here is to have more orderly markets, more developed markets as we move forward. And that's certainly what it's looking like. We're in the early innings.
Okay. Next question. How does the government imposed escalating tax, so that escalating tax that was in the graph, mesh with the concept of free market trading of greenhouse gas emission credits? So a free market trader has this government imposed escalating tax that impacts it. So almost
Yeah,
philosophical.
well, it's certainly providing a stabilization to the market. It's also, yeah, basically it's putting a floor in many markets by setting a higher price. Now, is that a totally free market mechanism? Probably not, but there shouldn't be any reason why the credits or allowances can't be freely trading, because everyone really has the same set of rules, although those curves are a little bit different depending on what country you're looking at. But when we looked at the ETF at the beginning of the presentation, that was the carbon index. That was a global index of carbon pricing. So that's really, I think, where we're ultimately going to get to, hopefully.
Okay. Okay. I have a question that came from that question. This is my own question. So I know there's other questions, but because I'm the host, I can. Is there any advantage to holding off a capital expenditure because you know it's the delta between the credits is going to increase? If you follow what I'm saying, if it's 60 this year and 70 next year, maybe I claim my credits next year because I get the 70 or the bigger change, or is my thinking flawed?
Well, I think, yeah, I think that can factor in, but looking at the curves and they're all upward sloping, it, you know, just sort of rule of thumb might be to accelerate investment to be able to get the credits in sooner, and then even if you're holding them, they're going to appreciate and you're going to be generating new credits each year. So but you know, that's really just a rule of thumb.
Okay.
You'd have to look at it case by case and project by project.
All right, good answer. Okay, for emissions trading to work, okay, I remember this is a similar question that I've heard people complain or say.
Okay.
The market needs buyers and sellers. So if everyone, what if there are too many sellers? Everyone's super keen. They go out and start doing things, especially if they're going to get government money to help them, because everyone is lowering their carbon emissions. Wouldn't this sink the market? Well, I guess it'd be good for the environment.
Well, it'll be driven by supply demand. I think as the markets develop, there are going to be more buyers. Who would have thought that there would be ETFs in carbon credits developed, you know, over the last few years? Like, so they're, you know, that's a source of more buyers in the marketplace. But you know, it is ultimately, I think, a function of supply and demand, and oversupply would likely push down prices. But you know, bearing in mind here that governments do have latitude to adjust emission levels as well, probably as we go forward here.
Okay, next question is, does a carbon credit expire after a number of years? So if you did a project that had credits in 2020, when can you put those on the market? Is it indefinite, or do you have to, is there a timeline for expiration?
Oh, they're different types, and certified and voluntary credits. There isn't an easy answer for that one. Ellen, can you elaborate on that one?
I think there are some limitations. You cannot hold them for forever. There are some expiries, so you need to sell them, or they will expire by the end of that period.
I recall reading somewhere that some environmentalist groups would buy the credits, so then they wouldn't get bought and used. So that's just an aside. I don't know why I brought that up. Okay, someone's trying to do math on your graph, Elham. So they're asking how you converted $30 per ton to 5.87 cents. No, 0.05. No, is that 5? Yeah, 5.87 cents per cubic meter in your table.
So it's based on the.
Don't get too engineering talk for everybody.
It's just simply based on the caloric value of the natural gas, or the energy, like gigajoule of energy in each cubic meter of the natural gas. Yeah.
Okay, sounds simple. Okay, that was good answer without getting into the hard engineering. Not that I am an engineer, but there's people that might not be. Okay, next question. What are the key drivers for an emitter between, oh, this is a good question. What are the key drivers for an emitter between 10 to 15 kilotons on the opt-in versus opt-out of that Ontario EPS, which again is Emission Performance Standard Regulation? Can a company flip-flop or change its mind at any time?
Okay, the key driver is obviously financial benefit and tax avoidances. However, opting in is may add some obligations, so they may not. They may want to change their mind later. I think there are some mechanisms that they can get out of the EPS regime later if they decide to.
Okay, and I think that's all the questions. I'll just double check on my screens. I think we answered them all. And it's perfect timing because it's 12:57. And I pride myself on finishing on time. So I believe we'll finish it off there. If you, perchance, any questions come to your mind to any of the people listening, feel free to reach out to Elham and Mark. They're not always charging fees. They can answer questions over the internet, email, etc. I believe their email contact information was in the flyer. You can always go through the CHAR or Altec website to find the contact information. And the other good news about this presentation, besides the fact that it seemed to go off without a hitch, is that you can see it again when you so want to, once we get it up on the CHAR YouTube channel. And like I said earlier, the slides themselves, we'll send them out to everyone that registered for the course. So barring a last minute check on questions, I'm going to conclude this session and wishing everyone stay safe and have a great work day. Thank you and goodbye.